Hello everybody, my name is Ed Schneider. I am here with AIC TV in conjunction with Dukascopy TV, and I'm here with my usual host, Ed Karr, who will talk today about strategic asset management. Strategic Asset Management is a company that was recently formed that has had quite good performance. I believe that last year the performance was about plus 9% on a net basis, and is very consistent. Almost all your clients made money. In fact, all of them made money in local currency terms. I'd like to know how you were able to do that, Ed. What were some of your key strategic moves there?
Sure. Well, Ed, thanks for having me. It's a real pleasure. You know, I'm usually in your seat.
Yeah, well, it's a pleasure to be in your seat and to finally give you the chance to talk about what you're doing.
No problem. It's the Ed and Ed show today here, ladies and gentlemen. Huh? So this is fun. No, you're right, Ed. Absolutely. And thank you for the introduction. Strategic Asset Management did have a really good year last year. We had a good year the year before that as well. And I think it just comes down to hard work, you know, how we did it. Most of our clients have pretty conservative mandates. As you know, just by the nature of being based in Switzerland, our clients are ultra high net worth individuals and institutions. So most of our clients are already rich and they want to stay rich. So we're not taking extravagant risks with our client money. We're trying to structure portfolios that give us quite consistent rates of return, that we can have absolute positive returns in all market climates with pretty low volatility. And we've been successful doing that.
You know, when we were talking though, one of the things that I noticed is you were very good at finding these little, what I would call niche alpha investments. Now, I know you talked about one up in the Nordic region that you did with some preferred stock.
Right.
I'd like to know more about that, and maybe the audience would as well. So
sure.
Please tell me some more about that.
Yeah, absolutely. And that's a good example of how we actually structure and manage the portfolios. So we go out and we try and look at some unusual opportunities that'll give us a lot of value for risk reward. For instance, we started taking a position in an SAS preferred. SAS is Scandinavian Airlines. So it's the airline based out of Denmark, Sweden, Norway. Most people know it quite well. And they had a preferred issue that came out. It was trading at about 550 Swedish kroners a share. After the initial offering, it really came down, traded about 380, 400 Swedish kroners a share. It pays a 50 Swedish kroner dividend yield.
Wow, it's 12%.
And 400 Swedish kroner, you're good in math. Ed Schneider's a smart guy, so it's a 12% yield. And you look at that, then you start looking a little more into the details and the prospectus. And wait a minute, 12% yield. Normally right now in this market, I would have to go into jurisdictions like Russia and take on massive geopolitical risk to pick up a 12% yield. Why is this issue paying so much? And I think that it's just a mispricing issue. You know, when we look at government bond yields around the world absolutely collapsing, a lot of government bond yields have gone negative, which means you have to pay France, you know, the right to hold your money for 3 years rather than getting money from them. You know, a 12% dividend yield on a Scandinavian airline that's completely backed up by the full faith and credit of those Scandinavian countries seems like a really good investment to us. So we started taking a position in that, like around 400 Swedish kroners a share. Today, I believe the share price is around 460 Swedish kroners. So it's naturally had a capital appreciation that we would expect, but you have an incredible dividend yield that you can hold on while that share price appreciates.
Wow. So that's a really good move. I'm sure that that's the type of trade that basically gives you limited downside and some nice, decent upside of at least 20%, it looks like. So that's a good move.
Exactly. Now you got to look in the exact same time the Swedish kroner has depreciated. So if you have a client that has maybe a US dollar based currency, US dollar has really been strong. It's been on fire in the last year. So you can easily hedge out that Swedish kroner currency risk if you're in US dollar based currency. In the euro, vis-a-vis the euro, it wasn't so bad. So you know, you have to keep in mind what the client based currency is as well.
Speaking of currencies, over lunch today, you just alluded to a very interesting concept since the recent, we could call revaluation of the Swiss franc.
Yeah.
And you had a concept for a future type of alpha trade with other currencies that are pegged similar to the Swiss franc. Can you give a little more color on that?
Yeah, I'd be happy to, Ed. You know, the Swiss National Bank, when they actually abandoned the peg a couple of weeks ago, it seemed to take everyone by surprise. And I looked at it and I saw for a long time, Euro Swiss was trading at 120, 120, 120, 1.20000 5.
Right.
And I just knew, like a lot of the market participants looking at it were, that this trade probably cannot hold. The Swiss National Bank just could not blow out its balance sheet ad infinitum. They were taking a lot of pain, and they just decided one day on a Thursday afternoon, let's abandon the peg. And boom, Euro Swiss blew out by 20-30% in that day. Unheard of move, you know, for a G20 currency to move 20-30%.
The world found out and felt it very quickly.
The world found out very quickly, and several hedge funds are blown up. Currency traders lost a lot of money.
FXCM.
Exactly. So it brings into mind, you know, the whole viability of all of these peg currencies. Can they hold? And we're living in a really interesting world right now where every central bank is trying to devalue their currency. It's a race to the bottom. They all believe that by devaluing their currency, they'll make their exports more competitive. They'll be able to get rid of deflation. And so you see it on everything from the Canadian dollar to the euro to the British pound to the Japanese yen, the mother of all quantitative easings, to South Korean won, et cetera, et cetera. And there's a major currency out there that's still pegged. You're a smart guy. You probably know what it is.
Could it be the Chinese currency?
It could be. The Chinese RMB is still holding their peg right in there. So when I look at the Chinese RMB right now, and I look at the peg and where we are today at about a 620 to US dollar, even though they're allowing the band to float a little bit more, look at some of the economic numbers coming out of China. They just had a 7.5% GDP print. Do you believe that? I don't. I don't. And why? I look at other data out there. Look at the Shanghai rebar futures. They're falling off a cliff. So construction activity is really declining. Look at the Baltic Freight Index, declining off a cliff, 30-year low. Nothing's being shipped. China is predominantly an export nation. If their GDP is growing at 7.5%, why aren't they shipping stuff on ships, you know? Look at energy consumption in China, falling off a cliff. So these things point to a much greater economic slowdown than the central government is telling us. And what's going to happen? Right now, due to the currency depreciations in other countries, specifically Japanese yen, South Korean won, even Singapore dollar, their exports get more competitive vis-a-vis the Chinese goods. So all of a sudden, the consumer in the United States, you know, Joe the plumber sits back and says, hey, I need a new television to watch the Super Bowl game on. He goes out and he looks. He can buy the Japanese TV for $300 or the Chinese TV for $1,000. What's he going to buy? It's going to buy the Japanese TV. Yes. And at some point, the Chinese are just going to say, we're not going to put up with this anymore. And I believe, you know, the centrally planned government in the Politburo in Beijing can just come forward with the stroke of a pen. Okay, we're going to undo the peg, and tomorrow it's going to trade at 10 RMB to the dollar. Now, the opportunity to trade is out there. The volatility in this market has been completely compressed. Why? Because a lot of hedge funds have been selling these options and a lot of income investors just to pull in that premium each month. Because they know this peg has been out there. So I'm a smart guy, I run a fund, I'm going to sell the options, and I'm going to bring in my little monthly premium. Maybe I'll have an 8-9% yield in my fund over the course of the year.
But aren't they like picking up pennies in front of a steamroller?
It's exactly what they're doing. And at some point, that is going to run them over. You know, it really is. So there is major opportunities out there if you look at the options, how they're priced, and you can buy some 12, 18, 24-month options that would give you an incredible rate of return. Now, don't get me wrong, Ed, this is a highly riskful trade. You know, this is a black swan event, that this trade is either going to work or it's not. You know, and you can go out, you could buy a call, you could buy a put, depending on which exchange. You know exactly precisely what premium you're putting up. If it doesn't work, that's all you're going to lose. If it works, some of our modeling says some of these trades could have a 30, 40, 50 times return on investment.
Okay, Ed, let me ask you then, let's be specific. Say you buy it at around 6.25, right? Your strike price is $6.50.
Yep.
And it costs you, I don't know, $30,000 to buy that option. Say the RMB goes to 8 6 months from now. How much money would you make? How would that work? Explain it to everyone.
Sure. Well, on a 6.5 strike, let's say an 18-month call, if the RMB went to 8, you would be in the money by 1.5 times $1 million underlying notional value. That option would be worth $1.5 million.
And you paid roughly
$30,000.
$30,000 for that option.
So that's a 50 times return on your investment potentially in the next 18 months if you believe that the RMB could go to 8.
And all you lose is the money you put in.
If RMB would be 6.5 or less, if the peg maintains, you'd lose that $30,000 premium. Exactly. Yeah.
And have you done that trade for some of your clients?
Absolutely. Yeah, and I think that really makes sense. You can hold the majority of a portfolio extremely conservatively. And let's say you have a $10 million account.
Right.
If you're mostly in cash, so you are ensuring the downside protection and the integrity of the account, and all of a sudden you put on a $10 million portfolio, maybe a $60,000 position.
Right.
So it's 60 basis points. It's nothing for the capital. And it hits, you'll make $3 million. So that's a 30% return.
Yeah. So, I think that trades like that are different than what I see most Swiss banks and other asset management companies doing today.
Yep.
So my feeling is I've known Ed Karr for a number of years, and this is an example of out-of-the-box thinking where you really find alpha opportunities in the market. And I think that you and your clients are in good hands, and I really enjoyed this conversation today. So thank you very much, Ed. It was a pleasure having you, and I hope I could host you again with some more of your really good ideas.
Thanks, Ed. Sounds good. Thanks for having me.
Thank you. This has been a presentation by AIC TV in conjunction with Dukascopy TV. It's been a pleasure having you, Ed, and I look forward to having more future interviews with Ed Karr and other AIC TV interviews.